Hello and welcome to the Mayar Capital Q3 live Q&A. My name is Angus Archibald and I'm part of the sales and client relations team here at Mayar Capital. I'm joined today by our founder, portfolio manager and managing director Aziz Al-Naim and our partner, head of research and portfolio manager, Aubrey Brocklebank. A warm welcome to you both.
Thank you.
Today's session is designed for us to answer your questions. So at any time, please put them in the chat and we will endeavour to answer them. Thank you to those who have already provided questions for the team, and which is where we will be starting today's session. So our first question, what is one risk or concern that is currently keeping you up at night?
Oh boy, one risk or concern. I don't think I can have one only. I think this is one of the periods where I'm certainly very concerned about a lot of things, some that I think are immediately important, others that I think are going to matter over the long term. Some do have immediate ramifications on our portfolio, and many don't. And kind of the way I think about it is if I wanted to split it into different categories, I think the thing that actually worries me the most individually kind of has nothing to do with the economy. It has to do kind of more of the geopolitical environment that we live in today. I think we live in a very precarious time. I think the world is on the edge of potentially really bad outcomes happening, and that worries me the most. There's nothing I could do about it. There's nothing that an investor can do about it, I'm afraid. But that's definitely the thing that worries me the most about the world today. I think economically, I'm worried about two big things. The first thing that I worry about is what's happening in kind of the debt market in general. And if I wanted to split it into two, I would say on the private debt market, I would be worried about what's happening. We've seen some defaults recently. I think on the one hand, it has the benefit, kind of on the pro side of things, that it's not in the banks, and so odds are, compared to kind of what happened pre-GFC, it's going to have less of a systemic effect. But on the other hand, it does also mean that because it's in the shadow banking, we really don't know the extent of it. We don't know what's lurking in the shadows by definition. So that worries me. Because we don't know what we don't know, I guess is the big thing here. More long term, I would say, is what's happening to the balance sheets of most of the world. I think sovereign debt is at unsustainable levels. We're looking at a demographic future where it's probably going to continue to go up. We're looking at a situation certainly in Western democracy where I struggle to see how politicians are going to do the right thing for future generations. And I think the path of least resistance is to try to inflate away the debt. I think in an environment where central banks could become less independent, that would open the door for that, which basically means we deal with high inflation over many, many years. Potentially that's why gold is reacting the way it is, though I think we'd be reading too much into the actions of central banks that are kind of been the main buyers of gold this year. But that would be my worry, that you're going to have very high inflation, political instability in the West, and lack of leadership in the world. And it does have, obviously, economic ramifications, and it does keep me up at night. Aubrey?
Well, I think you've covered a lot of risks there. So the sort of non-economic risk for me, I think, is climate change. And I think that the world is treating it as the world's risk-reward stance here is bizarre. Mm-hmm. That, you don't have to believe that climate change is happening, that man is doing it to say, we actually still need to do something about it. Look at the trillions of dollars that America spent on preparing for war with Russia up to the Cold War. They spent trillions on an event that never happened. Russia never invaded.
Yeah.
But no one says, well, that wasn't money well spent.
Yeah.
And I think the same is true with climate change. It doesn't matter whether you believe it or not. There is a risk of a really bad outcome. Why don't you spend money? And anyway, that is my non-economic risk. My economic risk, I think, is it's two parts. What if the bubble we're in does not pop? And part two, what if it does pop? So what if it doesn't pop? Well, we will probably underperform for that period of time. What if it does pop? Well, I think a lot of, certainly what we've said up to now is it's not systemic, so it shouldn't affect the broader economy. But the thing that keeps me awake is what if it does? What if the wealth effect destruction is such that people spend a lot less? And then that does have an impact on the real world. Now, I think so long as the banks are fine, we should be fine. But I think we do need to be cognizant that there are risks that are slightly broader.
I think that's a very good point. And I think one big difference this time around compared to kind of 99, 2000 is consumer spending now is much more concentrated in the top, especially in the US, in the top 10% of the population. I think it's 50% of consumer spending now happens by the top 10% wealthiest Americans. And it's similar elsewhere in the world. But then the other thing is the size of the US market in dollar terms as a percentage of US GDP and global GDP is much, much bigger than in 99, 2000. And so the wealth effect could be material to GDP, could knock off a few percentage points out of GDP over a couple of years. So I think you're right there that it could have a much bigger impact.
And especially with the advent of apps like Robinhood, it is easier to trade now than it ever has been. And we're seeing the retail participation in markets is at an all-time high. And I'm sure that is because it is easier to do so. But that just means that there is a bigger effect on consumer spending.
Yeah, definitely.
Great. The second question we have here is, what is your take on gold equities? Is it a good proxy to catch the gold price rally? Mining stocks in general have been absent from the portfolio, so please discuss.
Yeah, so I think in general, there are multiple reasons why we don't own gold or mining stocks in general. The pragmatic reason is that our fund as an ESG Article 8 fund is not allowed to invest in extractive industries, including mining. So that's going to be the practical reason. But obviously that is a self-imposed restriction that we put on ourselves a long time ago. So the second question is, why did we do that? And I think our style of investing has always been to look for businesses that could earn higher returns on capital over very long periods of time. And mining does not. I mean, it's the same thing. It's by definition a commodity. Now, if you get the timing right, then you could make a lot of money, but they're kind of more of a trading thing than a long-term business ownership thing. And so I just don't think it's our wheelhouse. It's not our area of expertise. I don't think we are going to bring any advantage to trying to predict gold prices or any commodity for that matter, which is a requirement if we're going to invest in producers.
Yeah, I think gold can have a very valuable place in a person's overall portfolio, but that doesn't mean to say that we should own it. We don't own fixed income. For the same reason, but that doesn't mean to say that people shouldn't own fixed income in their overall portfolio. So if clients feel that gold is a good part of their asset allocation, then I see the logic in it. But as you say, it's not our wheelhouse. So I tend not to think too much about the price of gold.
Yeah, well, I think the other thing I want to say is our job is to try to maximize risk-adjusted returns. And the only way we're going to really be able to do that is if we play to our strengths. We won't be able to do everything for everyone, not at an asset class level, or for that matter, even at a business type level. So there are a lot of businesses and industries that we don't touch just because we don't think we have an advantage there. And so we only play in a
metaphorical
metaphorical sense in areas where we think we can win. There's when I was a kid, people used to joke about this, but it's absolutely true. I will play any game once. It doesn't mean if it's a silly game of cards. If I discover that I've got no advantage, it will be impossible to get me to play that board game, card game, whatever it is ever again. To this day, even when there is like nothing on the table, no stakes, no money, I will not play a game if I don't think I have an above average chance of winning.
So that's why you've never played me in any game.
Exactly.
Sorry, that was just curious.
I guess the follow-on question from the team here is the UK budget is due in the coming months, and given the fund's allocation of 25% to the UK, do you envisage any major changes which could affect the fund's holdings?
Yeah, I think I'll start with a caveat that of that 25%, 7 percentage points or so is Unilever, which is not really a UK company. It's just UK listed. So I'd take that out of the 25. I'd also take Ashtead out of the 25 because it's mainly a US business but listed in the UK, actually in the process of relisting in the US. So I'd take that out of the 25. I'd take 4imprint, which is also listed in the UK but is mainly a US business. So I don't think it counts.
Samero.
And Samero as well, listed in the UK, mainly a US business. You take all these out, and we're probably looking at 12% or so that is really kind of UK listed and UK exposed.
If that.
Yeah.
I think it's closer to 10 or under. And because when you say predominantly US, we are talking about 90% plus US.
Yeah.
You know, I think Ashtead have 10% in the UK.
Yeah.
4imprint have almost nothing. I mean, maybe 1 or 2%. Smero has, again, a couple of percent.
Yeah.
You know, these are US stocks that just happen to be listed here.
Yeah. No, absolutely. But we do own some genuine UK stocks. I mean, you own Vistry, British Land, and Helical, and they are UK and UK listed and UK businesses, and they are exposed to the UK economy. So I think the problem with the budget question is that A, nobody knows what's going to happen. B, we've already learned from this government that they do something and 6 months later they change their mind. They've done more U-turns than... I do think the biggest problem that faces the UK is the lack of growth. And so when the government is struggling to make ends meet on the budget side and show a fiscally responsible kind of picture to the bond market, the biggest challenge that they have is that no amount of taxation can solve for a problem of lack of growth, because you solve the problem in the short term, next year, the year after, you're just going to have your costs go up, which means you're going to end up with this doom loop, basically. And the only way for a country to have a sustainable debt picture is to have growth. The only thing that I've heard in recent memory from the UK Chancellor that is kind of gives me a little bit of optimism is something that says we're going to go and try to reduce red tape for UK businesses and reduce paperwork and reduce complexity. And I think that is a step in the right direction. I think it's no matter what they say they'll do, the reality of the political environment is that they're going to struggle to achieve everything that they say they will do. And I really don't think they are ambitious enough in terms of what they should do. So I think in general, we try to get into situations where our downside is limited. And if things work out economically to the upside, then that's a cherry on top. And that's certainly the case with the UK stocks that we own. So we're not assuming an optimistic future. And I think if things do turn around economically in the UK, these stocks will do incredibly well. But we don't think we need the UK economy to do incredibly well for us to do well as investors. But we'll wait and see. Aubrey?
Yeah, so I perhaps don't want to get into my political philosophy too much, which incidentally is not really left-wing. It's Georgism, but you can look that up at a later time. Focusing on the actual budget, there are several things that could happen that could be very meaningful, though. One is further commitment to housing stock for Vistry. The government has already committed a huge amount of money to affordable housing, and if this were to be recommitted, if there were to be another Help to Buy scheme initiated, or if they bring forward some of that funding for affordable housing, that could be very meaningful in the short term. Anything they do on planning as well, but that can go both ways, but that's not so much budget. Then, if they alter national insurance, I'm going to be worried for Johnson Services Group. But we've already had that, so I don't think we're going to get.
Yeah, I don't think that's on the table. Not this budget. At least. Yeah.
And I do get the feeling that, whilst taxes will go up, I suspect it's going to be on assets, and it's probably going to be bringing capital gains tax in line with income tax, which I think has been something that the government frankly should have done a long time ago. And that would be, to me, that would be one of the best ways of solving, the sovereign issue, but at the same time not harming growth, because obviously you can't tax your way into growth. But actually, if you tax assets, it's not going to hurt as much as income. If you tax income, that is money that people will not spend. If you tax capital gains tax, is money that they weren't going to spend anyway, or at least not in the short term. So I think those are, perhaps the key things that I'm looking out for this time round.
The fund has historically been less concentrated in US equities than the benchmark. Can you provide some comments on why this has continued over the years and how you see this evolving?
Well, the short answer is that it's not actually necessarily true. I think over the past 5 years it's been true, but not necessarily before that. Actually, there were many periods when we were overweight US compared to the MSCI world. I think it's worth, the way it's evolved is that both the weight of the US in the benchmark has gone up and the weight of the US in our portfolio has come down over time. So that's kind of how it's evolved. The truth is, we're value investors, and we want to invest in situations where the risk-reward is meaningful. So our job is, and we've said this many, many times, is not to maximize returns at all times. Our job is to maximize risk-adjusted returns. And we've said this time and time again, but it's bear repeating. And there are times in the cycle or times within a specific market where basically the amount of risk that you need to take to achieve a higher return is just not acceptable. And in those situations, we basically dial down the risk or not invest or invest more conservatively, depending on the situation. And the US has been that for a few years now in terms of valuation. And so basically, we will wait it out. There will be a time when the US market goes down, and we will be ready to deploy. I mean, we continue to follow the businesses that we like in the US. We continue to update our valuations. We continue to update our checklists. It's just we've been finding fewer and fewer interesting opportunities in the US compared to, say, 10 years ago. But these things go in cycles, and cycles turn. It's just cycles take time.
I think all things being equal, we probably should be underweight US. And I say that because currently the US is 70% of the MSCI, but it's under 60% of the number of stocks. But that's just the MSCI, and we are benchmark agnostic. And that means that actually we look at the whole world, and there are many, many more non-US stocks than there are US stocks. That means when we're looking for new ideas, there are just more opportunities outside of the US. So I think the number is something like 46,000 stocks worldwide, of which 6 to 8 are in the US. You know, you should expect there to be more opportunities outside just given those numbers. That being said, the US does have many, many more high quality stocks. But then, actually, Europe has a huge number of high quality industrial stocks because, that's how that market has evolved. So, all things being equal, you'd see that. But, when valuations change, we look elsewhere. We sort of set our fishing net, where we think we're going to find the best value.
The other thing I think I want to add is that there's a number that we report in our core letter, which is the percentage of revenue that our businesses get from different regions in the world. That's more around what we think about when we're investing. And so we want to be globally diversified in terms of sources of economic value that our businesses generate, not where something is listed. And like I mentioned earlier, companies like Ashtead and 4imprint that are U.S. businesses, or Sumero that are U.S. businesses that are listed in the U.K. So it's not like we come up with this kind of top-down decision to allocate to different geographies and then we go digging under. It is just organically the output of where the opportunity set is. We fish where the fish are, basically.
I guess that leads me on to one of the questions that some member of the audience has asked us is, can you please talk about the opportunities where you are adding and some of the areas you're looking at that you're most excited about going forward?
Do you want to start there?
Well, obviously we won't mention the specific names, but we were doing our WIP meeting this morning. So WIP is it stands for work in progress. So, every week we have a WIP meeting where we discuss what are the best ideas we're working on at the moment. And this morning there were a handful of Japanese names that we were looking at and talking about. It's a market we've seen a lot of value in, and we're talking about 3 companies which appear very high quality, but we're at the early stages there. At the same time, there is a US consumer goods company that we are incredibly excited about that's pretty idiosyncratic and not really tied to the rest of the market. And I think maybe that's what we're looking for, and what most of our opportunity set is at the moment, fairly idiosyncratic stocks that aren't actually that tied to everything else that's going on in the world.
Yeah, one of the questions that Aubrey and I were discussing, I don't know if you can tell from my voice, but I'm just recovering from the flu. I've been kind of horizontal for the past week. But just because I'm sick with the flu doesn't mean I don't discuss stocks. So I was just kind of chatting with Aubrey.
Still part of the morning routine.
Absolutely. What else are you going to do? Just second bed. But we were talking about kind of what kind of exposures we have in the portfolio right now. What are the scenarios where big tech stocks implode, where are we exposed? If U.S. consumer implodes, where are we exposed? And kind of thinking about the different scenarios and trying to think through the portfolio and what kind of risks are in there and where do we want to... Because one of the things about, I mentioned earlier, the idea that we want to maximize risk-adjusted returns. There are idiosyncratic risks at the company level, and then there are there are collective risks that come from correlation at the portfolio level. And so we're always trying to think, okay, if I'm going to add a name to my portfolio, is it going to add to the collective risk, or is it going to subtract from the total risk of the portfolio? And so, like Aubrey was saying, we're looking for ideas where we think they have this idiosyncratic, almost like a special situation, where we don't need the market to be doing well for them to do well. And we're kind of thinking still about, again, this has been our stance for the past 2 years, downside protection. We are in an environment where we think we want to protect our downside first, and then we think about upside. And the reason that is important in an environment like this is we don't know how long this bubble is going to go on. But eventually bubbles do pop, and when they do, we want to be in a situation to take advantage and buy the things that sell off 80, 90%, 70%, whatever it might be. And that means that we need to have some cash, and we need to have things that don't go down or don't go down as much in that type of environment, so that we can deploy capital into them at that point. So that's kind of the way how we think about things in this environment.
There's been a few questions both online and prior to today. One of the major questions was really, given the rapid developments in equity markets, what is Mayar's strategic plan to diversify into advanced technologies such as AI, smart devices, and emerging pharmaceuticals? Is there just a discussion on that?
Well, I think that goes back to first focusing on where we have a competitive advantage. There is no point trying to chase something just because it's gone up if we don't believe we have. If you don't have a differentiated view versus the market on a stock, on a position, whatever it might be, even at a global portfolio level, not just sort of our fund, then why should you do well? Like, why should you outperform? Like, the only way you're going to outperform is if you have a differentiated view in the market. Otherwise, the market is fairly efficient in pricing things in, generally most of the time. Obviously, there are times like now where we think the market is inefficient and overprices certain things. But that should be your first question. The first question you ask yourself: what differentiated view that I have in my either information, thinking, psychology, analysis that the average market participant does not have? And if you don't have one, then the odds are you're not going to do well. I think when it comes to AI, I prefer kind of our AI, Aubrey intelligence, is my favorite type of AI. But history tells us that the front runners in technology almost always, and I say almost because there are some exceptions, don't end up winning long term. So it's called the first mover disadvantage. And so you often want to have a bubble when a new technology comes in. And there's no doubt that AI is a transformational technology. You want the bubble to pop and then to look through the kind of rebel of that bubble and see who survived, who's actually in a better position. And often it's the people who come up after the fact who end up winning. So I still think when it comes to AI, we're at the point where it's going to be very hard to predict who ends up winning. Certainly valuations make it so that even if you bought the whole thing, the odds are you're going to lose a lot of money. I don't think it's priced for kind of a positive return. I really think it's priced for a negative return right now. And then you said about kind of pharmaceuticals and kind of emerging smart devices. Again, I don't think we have an advantage. We like to stick to our knitting. We like to play in areas where we think we have an advantage. And you don't need to. One of the most beautiful things about what we do is you don't need to have an opinion on everything to do well over time. You just have to have the right opinion on a handful of things that you own. It's okay to say, I don't know how much XYZ is worth. And I think Buffett uses a baseball analogy where you're sitting at bat and people are throwing balls at you and you don't have to swing and there are no strikeouts. And I'm sure Aubrey's going to come up with a cricket analogy like it. But the point is, people feel like you have to have an opinion about everything, and you don't. I think on most things, the right answer is, I don't know. And you just focus on the areas where you do know, and just have the patience to wait out periods like this one, where the things that you don't know or don't have an advantage just happen to have their day in the limelight. But these things do turn, and they're painful, and they last longer than we'd like, but that's just, these things do go in cycles.
Well, you're right. Cricket is a far better analogy, but sadly, only Angus would, understand the reference. But I will, perhaps say that, I'll try one other cricket analogy that people might understand. There's one type of cricket called 20-20, where you have 20 overs each, And that's where you want to hit every ball, and you want to score as many runs as possible. But that's a short-term game that can be done in a couple of hours. Test match cricket, which is done over 5 days, and actually previously, a long time ago, could have been over a much longer period. That's where you don't hit every ball. In fact, you play for defence to a lot of shots, and the aim is safety. And the winner was always the person that is safest. Now it's been limited to 5 days. That's not always the case. And okay, I won't talk about Jeffrey Boycott, but as much as you'd like me to, Angus.
Of course.
Okay, but here's the thing. What's going on now? You've got, let's say, 5-10 companies, and they're all priced like they're going to win the whole market. But only 1 or 2 can win these winner-take-most markets. They can't all be right. So, yeah, you're right. We don't know which one's going to win. But it could be that none of them win.
Yeah.
Now, we've done this before, and you talked about it in the letter. We've looked at the capex that is going to be spent, and McKinsey, they say what, 7 billion, trillion. I'm trying to get my head around these numbers. Other people have said 5 trillion. Maybe with overspends, it's going to be 10 trillion. But
what's a trillion between friends?
Exactly.
Yeah.
But let's just start with 5 trillion, and let's just play with a few numbers here. So let's say you want a 20% return on capital. That's a good return on capital. That will keep things going. You need 1 trillion in EBIT. Now, that 5 trillion, it's going to depreciate in 5 years. So that's 1 trillion of depreciation every year. So you need 2 trillion now of EBITDA. Now, things are going well, so you're going to get 40% EBITDA margin. Okay, so you need 5 trillion of revenue. Here's the thing. That is equivalent to the world's total IT budget at the moment. So you have to double that budget. Now, that did not happen, between 97 and 2005. The world's IT budget did not double, despite how revolutionary that was. And simply, the world cannot afford to double its IT budget. Think about how many companies are out there on 10% margins. The vast majority of companies are not on 20, 30% margins. The vast majority of companies cannot afford to do this. So I don't see how that 5 trillion is really possible. But let's look at, let's say, okay, it's not that bad. Let's say it's only, 10%. They make their WACC, their return on capital equals their WACC. Well, actually, you know what? Then pricing is going to be competitive, so their EBITDA margins are going to be lower. Therefore, you're still going to need to make roughly the same amount of revenue. So either way, we are talking about an implausible amount of revenue. Not only that, but in order to generate 5 trillion of revenue, you have to save the customer or earn for the customer more. Well, okay, so you want to create 10 trillion of value?
I mean, you're being generous. I mean,
well, that's sort of half the GDP of China. Are you going to create that? What's more, if you do that through savings, well, guess what's going to happen? You're going to have a huge amount of unemployment, and that's going to reduce aggregate consumer demand. That was seen during the Industrial Revolution. Yes, long term it was fine, but you had what was actually called the Engels pause, as in Marx and Engels, and that was a period where aggregate demand did drop, and we look back on it and go, it was a short blip. Well, yeah, 10 years, 15, 20 years, that's actually quite a long time for an investor.
yeah.
So I just think this is almost implausible. If this happens, you will not see that level of spending. You are going to see very, very subpar returns for all these companies, huge amounts of capital written off, huge amount of price competition if it all gets built. And this could actually be negative for AI. Whilst the railroads and .com laying fiber, well, not .com, TMT, the telco bubble, that was actually very positive because a lot of railroads are still being used today. A lot, that fiber is still 50% underutilized, but it is still being used today. A data center built today will not be used 10 years from now. And if it is, it will be used for the most menial of activities. So because of that, if you have all these assets that just become wasted assets, you could stall AI development for quite some time if the bubble were to pop now. Now, I actually don't think that's the most likely scenario. I think the most likely scenario is at some point we say, actually, you know what, we're not going to be able to build all this because OpenAI are just in discussions with NVIDIA to guarantee their debt. NVIDIA are going to have to guarantee OpenAI's debt. This tells us so much about what's happening. It tells us that banks are not actually willing to lend to OpenAI without NVIDIA as a guarantor. So the financing for this is actually now starting to look pretty shaky because we are financing 5 trillion is not an easy feat, let alone 7 or 10 trillion. So I don't think this is actually all going to get built. And then, if it's not built, then where's the growth coming from? You've got to admit that the growth isn't going to be what people think it is, and valuations reset. But valuations can still reset just because people realize this.
Yeah, I think it doesn't take much for, if it does turn out to be just another cyclical capex cycle, and I don't know, your top line goes down by 50%. And your margins compress, and so your profitability goes down by 60, 70%. And then your multiple re-rates by another 50%. You can very easily get to a 90% drop in stock price for a lot of these things. I think the point that I think is very important to get from what Aubrey was saying is that we're not saying AI is not revolutionary, and we're not saying that it's not going to change the world. We're just saying that the timing of it is going to be longer than what people expect. And the ramification of that is that what's happening on the capex side doesn't make sense. So the magnitude, the quantum of the capex and the timing of it combined does not make sense. And that's kind of what tips it over. So in the end, and obviously, what makes it a bit trickier this time around is a lot of the capex is going into assets that do not have a very long lifespan, and I think that is different this time. Anyway, time will tell. But I think the odds are this is going to be really ugly when it ends. But we'll see.
Yes, especially because one thing I've heard from a friend who I can't name, but there's been a report into AI spend revenues, and a lot of these revenues are not actually from real customers. But when I say real customers, they're not from non-AI customers. So all the sort of OpenAI revenues that, I think, 7 billion run rate OpenAI is at now? Well, how much of that comes from the likes of us? Some, $50 a month. How much of it?
60, Aubrey.
60, okay. How much of it actually comes from us, people in the real world, and how much comes from other AI companies?
Like Perplexity.
Yeah. Exactly. And this is one of the problems that, the reality apparently is that very little is coming from external customers. The vast majority of it is all from other AI companies. So again, it goes back to this circularity of revenues that, NVIDIA is funding Oracle. Oracle is buying from OpenAI. OpenAI is doing a deal with and getting loans from NVIDIA. This circularity is not sustainable.
Yeah, and the revenue numbers that you're talking about, even if they were all real, they're still very, very, very small relative to
the capex spend.
The capex spend.
And the market caps.
Yeah, it's just, there is no business model yet. And I'm not saying there won't be a business model, but it's kind of like similar to what happened in the dot-com bubble, is that eventually the internet changed our lives, and eventually people made a lot of money. But that was like 15, 20 years later. And 15, 20 years later means that, fine, you're right, but in order for the CAGR for an investor to make sense, well, you need an 80, 90% drawdown in the stock price for that number to make sense, assuming you even know for sure that it's going to work out. I think I think a lot of people kind of hear us out and think we're like Luddites here, but we do use AI for a lot of things, and we do think it's very important. I do think it's going to get better, a lot better over time. But I think what's happening in equity markets and VCs and a lot of area is it's just people just get ahead of themselves. They get too excited, and excitement rarely, if ever, is good for an investor.
Well, look at what would have happened if you'd wanted to invest in search engines or online delivery in late 90s. Well, if you'd invested in Amazon, if you invested right at the beginning, yes, you'd have done fantastically well. But the truth is, when it had a 90% drawdown in 2000, 2001, you'd have probably sold out. If you'd bought at the peak, what was it you were saying? You'd have had to wait 15 years to get an IRR of
10%, yeah.
10%. That's a long time when you've invested in the winner.
Yeah.
One of the biggest winners.
It's actually the biggest winner of them all.
Yeah. Alternatively, you could have waited a year and bought it when it was 90% lower, and your IRR would be astronomical. But what if you wanted to invest in search back in 98?
Yeah.
Well, you wouldn't have invested in Google.
No.
Google again is the is the last mover advantage.
Yeah. If you'd bought the top 5 search engines in 98, 99, 2000, even 2001, you would have lost money.
Google, you wouldn't have even thought of it because they were nowhere on anyone's radar. They didn't have a leading market share. They were a little startup. And the same could be true with AI now. That the winner might be someone in a garage doing something really clever, way beyond our ken, that we don't find out about for another 3 years.
Mm-hmm.
Well, thank you both very much for today. This has been a very great discussion. I hope our members in the audience enjoyed themselves and got a lot out of the session. If there are any other questions that you have now and after the discussion we've just had, please direct them to the investor relations inbox and we'll endeavour to get to them offline. And thank you once again, and we hope to see you soon.
Thank you.
Thank you.